X of 21 series are aligned with acceleration mild this morning. That is a modest but meaningful level of cross-market agreement across the framework. The current macro regime is acceleration mild, with a confirmation score of 14 out of 21. The current macro regime is acceleration mild, which the engine reads mathematically as growth momentum accelerating at plus 0.06, while inflation momentum is accelerating at plus 0.01. The coherence score sits at moderate, and the confirmation score is 14 out of 21. By the framework's historical base rates, regimes with this degree of alignment held in roughly 47% of cases over 3-month periods when similar conditions were present. Compared with the prior read, the Atlanta Fed's GDP tracker improved over the past 2 sessions, and that matters because the growth side of the model is no longer drifting lower. In historical environments like this, cross-asset behavior often featured firmer commodities, pressure on duration, and more attention on inflation-sensitive real assets, a record of past behavior, not a forecast, and not a directive. Treasury yields are the first signal. The 10-year Treasury yield is 4.69%, and the 30-year is 5.23%, with the curve still positive at 0.50 percentage points between the 10-year and 2-year. In the framework, that sits in a red momentum state for rate pressure, defined here as yields holding above the upper end of the recent range, while long-duration pricing remains under strain. In our framework's reading of comparable periods, this roughly coincided with weaker long-duration bond performance and tighter financial conditions within several weeks, an observation under our methodology, not a forecast. The market question is simple. Does this level of yield keep pricing power, funding costs, and equity valuation under pressure? What would challenge this read is a sustained drop back in long yields alongside softer growth data. Initial jobless claims are the next signal. Weekly claims came in at 206,000, which remains low and points to a labor market that is still firm rather than slackening. That places labor momentum in a green state, defined as claims staying near the lower end of their recent distribution and not signaling a broad hiring slowdown. In our framework's reading of comparable periods, this roughly coincided with resilient consumption and steadier earnings revisions within 1 to 2 months, an observation under our methodology, not a forecast. The question for investors is whether labor remains strong enough to support spending without pushing the Fed into a tighter stance. What would challenge this read is a reacceleration in claims or a broader deterioration in payroll trends. Credit stress is the third signal. The backdrop shows the 30-year Treasury touching 5.34% recently, with the market also absorbing more geopolitical friction, and that combination keeps rate-sensitive credit conditions under pressure. In our framework, that is a yellow to red credit state, defined as spreads and funding conditions tightening enough to matter, but not yet flashing a full systemic break. In our framework's reading of comparable periods, this roughly coincided with heavier dispersion across financials and rate-sensitive sectors within several weeks, a record of past behavior, not a forecast. The question is whether higher real rates are simply repricing duration or beginning to tax balance sheets more broadly. Gold is the fourth signal. Gold is at 4703, up 1.71%. And the gold ETF is also firmer, which places the commodity complex in a green momentum state defined as a positive 1-day and multi-session impulse in inflation-sensitive assets. In our framework's reading of comparable periods, this roughly coincided with stronger relative performance in commodity-linked assets within several weeks, an observation under our methodology, not a forecast. The question is whether this move is a simple hedge response or a broader statement about policy, inflation, and real rate pressure. What would challenge this read is a reversal in gold alongside easing yields and a softer dollar. If the 10-year yield crosses 4.45% and holds for 5 sessions, in our framework's reading, inflation momentum showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. That level of yield pressure fits a regime where inflation-sensitive assets have tended to draw more attention from the market. If fear and greed drops below 15 and holds for 5 sessions, in our framework's reading, The confirmation score deteriorated in roughly 7 of 9 comparable conditions. A historical characterization, not a forecast. That would matter in a regime like this because confidence in the cross-series alignment would be under more strain. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. The Given engine does two things in parallel. First, the Given engine publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates already covered here. Second, the Given engine runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the Given engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols, the 4 layers do. The Given engine monitors 407 symbols across 4 layers, independently of regime. Members study the outputs side by side with the environment view, study which groups the framework flagged and why they matter in this setup, then decide for themselves. That is the Given engine in practice, a record of mathematical conditions, not a prescription. May. Potential, educational. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening, see which sectors are leading, and learn to read what's driving it yourself. That live view is the observation desk, the same 21 series and 407 symbols founding members study each morning, the environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1. You decide.